Welcome to the Explainer. Today, we're diving into a really detailed financial report on one of India's top manufacturers, APL Apollo Tubes. Okay, let's just jump right into the number that makes this company so interesting. Its revenue has shot up by nearly 25% every single year for the last 5 years. I mean, that is just a staggering pace for any company, especially in a heavy industry like manufacturing. So you see a number like that, and it begs the big question we're going to dig into today. Does the company's stock price already factor in all that amazing potential, or is there still more to the story? Let's find out. First up, let's get a handle on what exactly APL Apollo does and why they're such a big deal in their industry. APL Apollo is the #1 manufacturer of these things in India. Basically, think of them as making the steel bones for the entire country's infrastructure. So every time you see a new warehouse or a bridge or an airport going up, there's a really good chance their products are literally holding it all together. Now, to really understand APL Apollo's success, we've got to zoom out and look at the bigger picture. You see, the whole steel tube industry is going through this massive shift, and that context is absolutely key. The report highlights this really important trend. The market is moving away from all those small, local guys and shifting towards major companies like APL Apollo. And the reason is pretty simple, right? The organized players can guarantee quality, they're compliant with regulations like GST, and they have the scale to deliver anywhere. This shift is a huge advantage for the market leaders. And on top of that, you've got government policy that's creating this powerful tailwind. We're talking huge infrastructure spending, all these housing initiatives, and new quality standards that are basically pushing business directly towards the organized players who can meet these higher demands. All right, now for the real core of the analysis, the company's report card. Let's weigh its financial strengths against its weaknesses. So on the one hand, the report highlights a major strength. This company is highly profitable. A return on equity of 18.2%. That means it's generating a really impressive return for every single rupee of shareholder money invested in the business. It's a very strong sign of efficiency. But on the other hand, the report does flag a concern. A debt-to-equity ratio of 0.8 means the company uses a pretty significant amount of debt to finance its operations and its growth. Now, this isn't necessarily a huge red flag, but it's definitely something that needs to be managed carefully, especially in a cyclical industry. So the crucial point here is that the company's strengths are really rooted in its market dominance, that incredible growth we saw earlier, and its operational efficiency. It's not just growing for the sake of growing, it's actually getting better at turning that growth into profit, and its brand is a massive competitive advantage. However, the report is also super clear that its weaknesses are tied to the risks that are just part of the game in manufacturing and construction. You know, the price of steel goes up and down, construction has its booms and busts, and managing all of that requires a really skilled hand, especially with that debt on the books. Which, of course, brings us to the million-dollar question. Based on all these pros and cons, what does the report actually say is a fair price for the stock? So the analysts ran 3 different scenarios based on how the future might play out. And their most likely one, the base case, which they give a 60% probability to, suggests a fair value of around 1,650 rupees per share. This is based on continued steady growth, pretty much in line with everything we've been talking about. And you know, this analyst's view is pretty much echoed by the wider investment community. This quote sums it up perfectly. Everyone agrees it's a great company, but the big debate is whether the current price is a bargain or if all the good news is already baked in. So, after weighing all the evidence, the industry, the company's performance, the valuation, what is the final recommendation? Let's bring it all together. The report's official recommendation is a buy. But, and this is a big but, it comes with a pretty important note of caution attached. It's not one of those screaming all-in kind of recommendations. And that caution comes directly from this number. The potential upside from the current price to the analyst's base case target is a pretty modest 11%. For a lot of investors, that just might not be a big enough reward for the risks involved. And that leaves us with the final and most crucial takeaway from this report. It confirms APL Apollo is a high-quality business, and it seems to be at a fair price. But the ultimate decision really depends on you, the investor, and how much of a safety cushion you want before you put your money down. So the question is 11% enough for you? That's what this analysis leaves us with.